everyone, and a warm welcome to all of us joining here today for the Trading Heads episode number 3. So, about Trading Heads, these webinars, what we do, it's a free web series where generally we invite CMT charter holders and trading titans to unravel the moves and the mindsets and the myths they have mastered. Today, this week, it's my absolute honor and privilege to introduce a true legend of systematic trading, Mr. Jerry Parker. Jerry isn't just a trader; he was personally trained by the legendary Richard Dennis as part of original turtle traders. I think there were 14 turtle traders. There was an experiment in 1980s in US, which was a groundbreaking moment in trading history that proven trading could be taught with discipline, rules, and a system. So it proves that basically that anybody can make money if he has a system and if he follows the system with discipline. And also, technical analysis can be used to profit, right? So it was a big event for all the technical analysts as well. From that incredible beginning, Jerry went on to chart his own path. He founded Chesapeake Capital, managing billions using trend following principles over the decades. His approach has stood the test of time across bubbles, crashes, and chaoses, consistently driven by risk management, patience, and the power of compounding. He's not just a practitioner, but also a philosopher of rule following trading, often reminding us that diversification is our edge and that simplicity, when paired with discipline, can beat complexity. Today, we get a rare opportunity to peek into the mind of a turtle who became a titan. Please join us. Join me and in welcoming one and only Mr. Jerry Parker. Hi, Jerry.
Good morning. Good morning for me. Good evening for you. Thanks for that great
Yeah,
introduction. You did a really good job on that. I love pairing simplicity with discipline. I firmly believe in that. That's very good. I like that.
all right. Thanks. Okay. So, Jerry, before we start, say many people may not know about this experiment. So, in short, can you explain this experiment which Dennis Parker did? Sorry, Richard Dennis did.
Well, in 1983, Richard Dennis put an ad in the Wall Street Journal and the New York Times, and he said he wanted to hire individuals to come to Chicago and learn how to trade futures. And at the time, I read the interview. I had heard about Richard Dennis, and I knew it was a good opportunity to learn from very smart people. But I didn't know it was about trend following. But I had already learned a little bit about trend following, and I thought trend following was great. And so I applied, and I got the job. And so when we went to Chicago, we had a 2-week course on that Rich taught along with his partner Bill Eckhart, and they taught us how to trade futures, currencies, commodities, stock futures, and bonds. And they gave us $1 million to manage in January 1984. And so that's what we did. We managed that money for Rich. And over those 4 years, we learned a lot from him. And I'd say most years, everyone in the room, it was about 20 turtles in total. And we were making between 100 and 200% a year. So it was really volatile and a lot of risk and large drawdowns. But after 4 years, that program ended in 1988, and I started Chesapeake. And I quickly changed the volatility profile to something a lot less, trying to make 15 or 20%, because when you're trying to make 200%, the risk is just too high, and you're trying to get clients to invest in your program. It's very difficult when the volatility is so high. So we pretty much did the same thing and follow those rules and those principles that we were taught. And we still do that today, but at a much lower leverage and risk level. So, and I'd say the biggest changes over the years has been to trade longer term. The turtles traded very short term, and now the short term trend following doesn't work as well. And then, of course, one of the most important things we did over the 40 years has been to add more markets to the portfolio. So now we trade hundreds of markets, many more currencies, many more interest rates, um, more commodities, and we're one of the few CTAs, trend following CTAs, who trade individual stocks using the trend following strategy. So in a nutshell, that's pretty much what happened in a very quick overview of the turtle years. It was a great 4 years, and we learned from genius people. And I'm still doing pretty much very similar strategy than when we started in 1983, longer term and more markets.
Great, Jerry. Great to hear that. Yeah. So let's start with some of the basic questions. Like we all know about total strategy, right? It's basically Donchian channel and moving averages and 8 average stop losses. I think that is the base, right? So it's a 10 point strategy which is basically based on breakouts. But say, what about a range-bound market? Like, what can we expect the strategy to do in a range-bound market and noisier market?
The strategy won't perform very well in a range-bound market or the type of markets we have now that are very noisy with lots of high volatility. So the strategy needs to trade in lots of different markets. So you reduce the chance that you will have all the markets you trade will be range-bound. And also, a longer-term strategy will reduce the number of trades you do, so you're not continually being whipsawed long to short, back to long, back to short so often. So those are the two things I think that work very well um, for range bound, and it actually works in all situations to trade longer term and to trade more markets. But to some degree, it is possible to get stuck in a strategy in a period where lots of the markets and most of the markets are range bound, and you're going to just take a lot of small losses.
Okay, so basically, you mean to say that it will work if your universe is big enough, right? Uh, and like in some places, you can have a series of losses, but the losses will be small.
Yes, yes, taking small losses is one of the keys to trend following and successful trading and risk management. Make those losses small, not too large, but an optimal loss, which can be uncovered by doing some back testing. But you don't want the losses to be so small that you're continuing to get in and out of the market every day, or um, and so large that they're really not small any longer. So it's really an optimal loss that's going to be determined by a back test.
Right. So basically, the stop loss should not be very close to the price, and it should not be too far away from the price as well.
Exactly, exactly.
Okay. Does turtle trading work in a situation where, say, the stocks are showing a trend, but the overall market is not in sync? Some sectors are not in sync, right? Because many times not all sectors work, right? Say, how does it perform in such situations where market is in another direction, and some of those stocks are going in some other direction?
It's a very good question. I would say that the way that I handle this is I ignore the overall market trend. I would just look at individual stocks. Some are going up, some are going down. And if the overall market trend starts to dominate all the stocks, then you'll eventually your shorts will become longs or go flat to long. Or if the market is going down, your longs will become flat and become shorts possibly. So I think it's very important to in the stock market and in all markets to have longs and shorts. But I would say that you want to apply the trend following strategy to each individual market, currency market, the yen, the dollar, or the British pound, and not pay attention to some sort of overall market trend. Uh, so much. And I don't pay attention to it at all. It's very important. It's like right now, I would say that with US stocks and with European stocks, let's say, we trade a lot of these individual stocks, and the trends are about, they're different in all the stocks. About half our stocks are long, and about half of them are short. So, um, and this is a period where there is really not a great overall market trend, but that was prevalent months ago when the market was trending higher. We still had a fair number of shorts on. So you can have situations where the market goes higher as represented by an index or the S&P 500, which these indexes and the ways we measure overall market trends, they have issues with the way they're constructed or with cap weighted. So there's a lot, it's just better to pay attention to each individual market itself and apply your trend following to that. And sometimes it's not going to work well, and sometimes it will work well. And I think overall, that's the best way to do it.
Great. Yeah. Just for the participants, what we'll be doing in this session is that we'll be taking questions framed by us uh, till around 45 minutes. So say by 7:45 India time, we will be taking questions by us. And then the last 30 minutes, say 15 to 30 minutes, will give you all opportunity to ask questions with Jerry. Right, Jerry? Is that fine with you?
Yes.
Great. Okay. Okay. Jerry, if your trading system has stopped, suppose, right? And say, how will you recognize it that say it is not working, and what should be done the next, right?
That's a very good question. Um, I would not recognize that if my trading system stopped working tomorrow, I would not recognize that it had stopped working because with trend following, and one of the keys is to do this back test that generates thousands of trades, and you must use all of the data, not just use recent data, which won't give you a large sample size of trades to look at, or overweight recent data. So I look at all of the data going back into the 60s and 70s and 1960s and 70s and all the way through to 2025. So we're looking at all of data and looking at all those trades and trying to come up with thousands of trade examples in a sample size we can rely upon. So if we started getting poor um, performance, we wouldn't really do anything different because we would just say, well, that's just recent, and we don't have enough evidence that this system has stopped working. And so far, I think that's always been the case because the markets would start trending again. And I do think that one of the reasons that systems stop working is because they're too short term, possibly, especially trend following systems that are too short term. They get chopped up and they don't participate in the long term trends that can last a year or two. And that's really, I think, what is possible, still possible with trend following is devising systems that have a holding period of 9 to 12 months, let's say, and they participate in trends that last for a year or two, like the cocoa trade. Cocoa is a good example. Um, I'm still in my cocoa, and by my definition, the trend has not changed. It's still an uptrend. So that's a good way to go and overlay your trend following system on cocoa. And if you've been in and out of cocoa over the past few years, then in my opinion, you're trading too short term. If you're still in cocoa, not too short term. I think it's possible to trade I like to trade multiple systems, uh, starting from medium term to really long term. So maybe if you have a shorter term system that got out of cocoa, okay, maybe that's okay. But the majority of the systems should be longer term enough with the trailing stop not that close to the getting hit in this particular cocoa trade. So you can really participate in these trends that last for a year or two. And that's a long time. And I think that sort of is like, and you have to sit with a lot of drawdown and volatility. And it probably is really something people are not used to. But I think that's what continues to work in trend following.
Okay. Say, what techniques do you use to maintain discipline and resist the urge to override your system during extended drawdowns and manage the psychological as stress that comes with large extended drawdowns?
Yes, there is some psychological stress. I think that it's experience for one, and I've traded for over 40 years, so I've had many times where I've experienced drawdowns and volatility and had psychological stress. And I think in hindsight, I've always determined that it was better to not have deviated from my system, and not overridden the system, but to maintain the discipline and resist those urges and stick with the system. I think I've never succeeded in overriding the system. It's always been a little bit worse to have overridden. So I have no memory and no experience of having um, been rewarded for a lack of discipline. So that's good. But I do think it just takes experience. And I think sometimes people get in trouble and have these psychological stress during these periods, primarily due to trading too large. So if you're really stressed out all the time, you need to trade smaller. Like I'm almost never stressed out. So that's probably a pretty good indication that I'm not trading too large for my personality or for my ability to survive. I do think sometimes when you have extended drawdowns and you're losing money, you need to ask yourself if you're trading too large and if you need to trade smaller right now and reduce your positions and reduce your trading size in the future to preserve your capital. I do think that sometimes we don't want to ignore our psychological stress and our fear of drawdown because we're trading too large and we should be afraid. The most important thing for every trader is to preserve their capital so they don't have to stop trading. It's the most important thing ever. So sometimes you're going to need to do that and trade smaller, trade smaller now, trade smaller in the future, and go right back to following your system. So whatever it takes for you to follow your system and be disciplined, you need to do that. And sometimes it is just simply trading smaller.
Perfect. Yeah. Looking back, what part of Richard Dennis training had the deepest and the longest lasting impact on your trading approach?
Beautiful question. I love that. Trading is hard. Trading is difficult. You need to do the hard things. You need to do the right things. I think Rich said at one point, I've already said this, but I think we asked him, what is the most important thing about trading? And what do we need to remember the most? And he said, trade small and follow your system. I just got finished saying that. So it inevitably comes back to that. You're not going to do better. Your discretionary attempts are not going to make your performance better in the long run. And trading small, everyone trades too large, especially initially. It's the one thing I think that we really need to follow our gut and our heart with, and that is it's okay to trade small, and it's okay to try to make 10 or 15% a year and not make hundreds of percent. It's really the most important thing about trading is to stay in the game and do all the trades you should do and only do those trades. Um, but I do think we should embrace volatility and drawdown and losing streaks and realize that part of the reason that trend following works is because it's hard, it's difficult to do, it does produce these psychological stress, and that's why it continues to work. So because so few people can't do it. I think people try to take trend following and add things to it to make it better for them. And I think if you can't trade a strict trend following strategy that takes small losses and lets profits run, it doesn't get out of profits too quickly, then you probably should not trade. That's always an option. Don't trade. It's much better to stop trading than to take a good trend following system and add things to it that will help you lose money in the future.
Perfect. So, were there any core turtle rules eventually that you discarded or evolved in your own systematic trading career?
I would say in general, no. The turtle rules were that good. The turtle philosophy was amazing. These were genius people teaching us how to trade and telling us, look, we're not going to give you the parameters and the rules that are going to work forever. You're going to have to evolve over time. But the philosophy of going with the trend, taking small losses, diversifying, protecting your capital, um, and being really concerned about your back test and having a sufficient sample size and being able to count that sample size. These things lasted my whole career, and they still are great. And we would change in a heartbeat. If we thought we could make things better, we would definitely do it. I would say, like, once again, the biggest changes were to be longer term. And we started trading individual stocks because Richard Dennis told us how important diversification was. And I think once you start trading all the futures and the currencies and the commodities and the interest rates, and we even trade interest rate ETFs because some of the interest rate sectors like mortgage backs and high yield, tips, corporate, they don't have futures markets. So, but once you get through all of those, you're left with thousands of stocks all over the world that you could add to your trend following system, long and short. It could increase diversification. So I think trading longer term and adding stocks were the things that we did. But the reason that we've had so much success is that we stuck to the basic rules and didn't try to change things too much. Trend following is wonderful. It's the greatest thing going. If you adopt it, you can be successful. But the tendency is it's too simple, it's too volatile. I have to change it to suit my personality, and that's, I think, the road to failure.
Perfect. Perfect, Jerry. So, say there were a lot of people in the original turtle group, right? And diversity was there of personalities. So, how did that affected the way each trader interpreted and applied the same rules? Like they were all given the same rules. That how did they uh, did it?
These are the best questions I've ever had. These are great questions. I really love these questions because they're really interesting. You really took some time and thought about these questions. It affected us because it was, I think some people didn't think Rich was giving us all the rules. We were losing trade. We had losing trades. We had drawdowns. So he must not be giving us all the rules, which was silly, right? I think some people were afraid of volatility, and Rich wanted us to trade large and make 200% a year. And that really impacted people. They just could not do it. Um, the most important thing about the first, when we first started our career, Rich said was just do the trades. When you have a trade, just do it. Don't be afraid to do it. And when I first started, I was too afraid to do the trades. So I got a little shy about doing the trades. And he called me on the phone and he said, how many trades did you do this week? And I said, maybe 5. And he said, how many do you think you should have done? I said, probably 20. He goes, yeah, just don't be afraid, do the trades and don't worry about it. So, I remember telling Rich in the interview, I was really disciplined and I would follow the rules. And then when I had the opportunity for the first time to do that, I didn't follow the rules. I was too shy, too afraid to put the trades on. I didn't want to lose money. And I think that you need to go through some experiences. And it's okay to fail when you're early. Trade small when you first start. You're going to make mistakes. The biggest mistake is not putting a trade on because with trend following, the biggest mistake is missing a big trade. There's so few of them. Your performance is going to be determined by capturing these big outlier trades. And when the first trade came around in January, February of 1984. It was February heating oil, and it like doubled in price or something. And very few, or maybe half the turtles even took the trade. So there you have it. We all came out. We all promised to be disciplined and follow the rules, and yet half the room didn't even put the trade on. And when you first put the trade on, you have no idea if it's going to be a great trade, obviously. So there was a lot of pressure, but I'll just say one thing: it just takes practice. Stick with it. You can get it. If I can get it, you can get it. But really, you just have to realize what's important. Putting that trade on. I think once you have a trade on, it's not that hard to take a small loss. Maybe you even want to take it off because you're happy to take it off because it's a small loss. But I think the fear of taking a small loss actually happens to some people before the trade. I didn't even want to do the trade because I didn't want to take a small loss. And so you've got to do the trades. For every trend follower, that's the most important thing. Put that trade on, follow that rule, and hold on to it as long as the system tells you to. And that should be pretty uncomfortable. It's not going to be fun holding on to these big trades because we kind of want to get out of the trade too quick and take a small profit or medium-sized profit versus giving it all the room that we should based upon the back test that says, hold on, be bold, be tough. And that's really hard to do. It really takes experience. Some people were good from day one, and some people like me, it took a while.
Great, Terry. In say now, in today's world, now we have machine learning, AI, artificial intelligence, all those things. Yeah, so do you still believe that simplicity in rules outperforms complexity in the long run?
Well, I'm afraid that you need to have the simplicity in the rules, the few rules, few parameters, in order to have confidence in your back test. So complexity just adds more, um, fewer trades to look at. And so I think that's the problem with making things more and more complex. I think with my style of trend following, I get all the big trades. Maybe I have a little bit more volatility and more maybe more drawdown, but that's the price that you may have to pay, be willing to pay for a systematic approach that's more reliable. I think with AI, which is sort of attempting to predict the future, that could be problematic because we have seen things over the past years that have never happened before. What would AI have predicted with COVID? Um, so I'm not sure how AI fits in with a systematic approach that tries to sort of predict the future and foresee these things happening. Um, I think simple trend rules will still be able to work, even if AI is successful.
Perfect. Great to know that because like, everybody is fearing that with all these AI and everything, you can code your rules using chat GPT and how successful that will be, and then can we make money if that is everything is making systems using chat GPT, right?
I use ChatGPT for some things, but I don't think ChatGPT um, is going to be able to help us with things we've never seen before. And that happens a lot. We see things in the world that we've never seen before, and it produces trends, and trend following is very reliable for that.
Okay. So, what's your perspective on entry versus exits? Like many people, in fact, most people talk about only the entry point, but very few books are there on exit, right? Or very few people actually talk about exiting with a proper stop loss or whatever target or whatever. Where do most traders over engineer and overthink, right?
Yes, there's a lot of over engineering and going on. I think with the entry, as I said earlier, I think the entry and the exit are very important. They're equally important. For a trend follower, you can't miss the big trends. So Don't have a filter, don't have an entry. It's okay to maybe have a filter that delays the entry. Um, if you want to combine a breakout or a moving average with Bollinger Band or something, that's fine, I guess. And eventually you'll get in. You have to set the parameters. So it's maybe a little delay. And so maybe that'll keep you out of some more bad trades. But you really need to have an entry that doesn't allow you to miss a big trend. And the fact of the matter is, if the market is going up, it might be a big trend, and you better get into it. And that's all you need to know. Um, I think on exits, they're a little bit more tricky because the exits sometimes people give more thought to, because with these big profits and big trends like cocoa and coffee and gold, I like to trade different exits, have different entries, different exits, different systems. And it's going to matter. It's going to matter where you get out of gold. If your exit is shorter term or longer term, if you get out too quickly, you have to get back into gold. And the longer term systems are still in, so that helps. But then when gold finally turns around now, or 4,000, 5,000, 6,000, wherever it's going to go, there could be a material give back in profit. I think that over time, when you look at all these different ways to exit using systems that are fairly long term, what I've seen is all the exits make the same amount of money over the whole test period. Now, of course, it's going to be much different over any one individual trade. So you're really in a good situation where you're going to get rewarded for trading multiple systems with multiple different exits, all of them medium to long term, though, and on any one individual trade. But then over the long term, they're all pretty much the same. So you can help yourself on some of the drawdowns and some of the bad periods by having different entries, different exits. And but I do think that once again, I am not in favor of exits that where people reduce the position based upon an increase in volatility or increase in correlation. I think a good trend follower wants to stick with the trend regardless, and not and have a system and exits that don't get out of positions until the market shows that the trend is changing. So I'm more in favor of uh, you know trend following entries and trend following exits, and not exits that reduce positions based upon any other factors.
So you just talked about correlations. Generally, we suggest that if few of the instruments in our portfolio are extremely correlated, then we take less quantity in them, so that because they will move in the same direction, right? So, do you use correlation or some portion of correlation? Do you think it is useful, and we should see correlations on, or say negatively correlated stocks should be there in a portfolio? Sorry.
Um,
Yeah.
I look at correlations when I put together the portfolio. So I think I have 25% of my portfolio is currencies, 25% is commodities, 25% is interest rates, and 25% is stocks. So I think it's good to look at correlations and when you build a portfolio and decide which markets you want to put in your portfolio. But then I kind of after that, I don't really pay too much attention to the correlations, because sometimes you can have markets that are highly correlated, um, but one of the markets or two of the markets out of many will be the big trend, will be to have the big move. Back in 2020, when commodities, they all kind of started going up, they were all correlated, but of the of all those commodities, maybe just four or five had tremendously large moves. So you don't want to have the correlation have too much influence over your positions, because you might choose to scale back on trades that are going to be the bigger outliers. So I do think that, because trend following produces these outliers, and they are responsible for your overall performance. But sometimes we get lucky and the whole sector moves. And so everything is moving. Like in 2022, when all the bonds went down, or in 2020 when all the currency commodities went up. So it is good to have this diversification and to be able to make money when the whole sector starts moving, and that's really good, fun thing to experience. But also, you want to keep those full positions in each individual market so you can really make more money with the markets within those sectors that have the big outlier trades. So it really just correlation and starts and ends for me with setting up the portfolio to determine which markets I'm going to trade. And I trade all the markets with equal weight. Yes.
Okay. So the original trading rules had position sizing based on volatility, that is N divided by ATR, I suppose, right? So do you still use that for position sizing, or now you have evolved and keep it equal weight?
Can you say that question again?
Yeah, the original turtle trading system had position sizing based on volatility, right? Which is basically N divided by the ATR. Right. Now, do you use the same method for position sizing, or you use equal weightage for position sizing your trades?
I use the ATR to size the positions based upon the ATR. And so, yeah, so if a market is really volatile and it has a high average true range, we trade it smaller. And then if a market is low volatility, a low average true range, we trade it larger. So it's the same formula using ATR. And I think that effectively makes all the position sizes the same. Now, as I said earlier, as the trend gets going and it becomes a bigger trend and maybe a large trend like gold, and the ATR for gold now is much higher than it was when I put the trade on, I don't adjust the trade. A lot of CTAs, most CTAs adjust the trade smaller as the gold continues to go up in the trend, and I don't do that. I have my stop loss when I put the trade on. It's based upon the ATR as well. I'm going to take a small loss when I put the trade on. And if it keeps going and making money, I don't consider that not to be a situation where I'm going to lose capital, and I really don't try to scale that trade back. I think good trend following says hold on to that trade, even as it gets more volatile. And this is the way you're going to make bigger money. This is how you're going to have those outliers by not reducing the position. Yeah.
Okay. Jerry, in volatile markets like cryptocurrencies or any new asset class, the traditional total trading risk management rules still hold up, or do you have to adjust your rules?
Oh, I never adjust my rules. I haven't adjusted my rules in a long time. Um, I think I think the total money management rules, the ATR, the way that we did all of those, trading all markets, the same systems and the same size using the ATR function. I think none of this needs to be changed. I think the one thing I would consider changing, which I haven't changed over time in a long time, would be, am I trading too short term? Am I getting chopped up? Am I fully participating in long-term trends? Or is one of my systems or two of my systems still a little bit too short term? Is the system, when I do a back test, is it deteriorating? Is it getting worse or is it getting better? So these are the questions you might ask yourself. But I think in general, um, the reason I don't think that it's necessary to be too worried for me, to be too worried about my systems is because what we do is so hard, it's so psychologically difficult. And most people are trying to refine their systems to avoid the drawdowns and avoid the losing periods. And so it doesn't make them want to trade the way that we do. So we don't really have a lot of people saying, hey, I'm going to trade just like Jerry with this old-fashioned classic trend following that likes drawdowns and takes small losses and doesn't pay attention to giving back profits and so this is not something where there's a lot of competition. So I think that if anything, I need to become more like that, maybe more longer term and accept more drawdown and more volatility and try to do make what I do harder to enjoy.
Great. Okay. Jerry, what's that one psychological bias you see even in experienced systematic traders?
Well, I think experienced systematic trend followers should know better and not use Sharpe ratio as a way to measure their performance and risk. But I say one thing that bothers me more than anything, and I talked about it earlier, and that is that your trading system should be tailored to your personality. Jerry likes drawdowns. Jerry will have drawdowns. He'll take small losses. He'll let profits run. He won't scale back the trades when volatility increases. I don't like that personally, so I'm going to change my system. I mean, that's the silliest thing I've ever heard in my entire life. Trading is hard. It's difficult. The market doesn't care if you like it or not. You want to make this money and you want it to suit your personality. Well, Jerry, I can't follow a system that I don't like. Then don't trade. Do not trade. You should be seeking out hard systems, tough systems, systems that produce psychological stress in other people. And then over time, you can figure out ways to overcome this psychological stress and put your total faith and desire into following the system. Systematic traders should grade themselves on how they follow the system, not if they made money. Now, over time, you need to make money. And if you're not making money, you need to quit or you need to improve your system. But if you follow the systems during this particularly bad period in March and April, then you followed your systems the way you should have. You did all the trades you should have. You lost a lot of money. Give yourself an A plus because you did what you had to do. And if you keep doing that, you're going to be just fine. And so I think that trading in a way that suits you, nothing suits my personality, nothing good. And if that's what you're after, ease, comfort, and pleasure, then trading's not for you.
Great. Generally, people say that you should trade a system which suits your personality, but you are saying that make yourself so strong that you are able to trade a system, right?
Create a system that's good and makes money and it preserves capital and learn to love it and learn to enjoy following it and make that your bottom line and not whether it brings you happiness. It won't bring you happiness. You'll have bad days. Having bad days and having drawdowns and losing trades is part of what works.
Perfect. Yeah. Yeah, right. So how do you personally deal with regret, some missed trades or say early exits or system failures? Like these things do happen, right?
Yes, I think, well, I think two of the three there are different than the system failures. So missed trades and early exits, there's no way to deal with it. Uh, you should have regret and you should promise to yourself that you're never going to do those again. Missed trades are trades that the system told you to do and you didn't do it. Early exits, that's a big no-no. You can't get out too early. The computer will tell you on the back test what the proper and optimal exits are, and you need to follow those. And if you get out too early, then you're going to be punished, and you should be punished. And you should have a lot of regret, and you should promise that you're not going to do it again. System
Okay.
failure, I think, is something different where you have a system and it's not working well. I think you should not have a regret for that, but you should improve your system and see what you're doing wrong. And I've laid it all out, in my opinion. You're not missing trades. You're not getting out too quickly. And if you have a system failure, it's a good learning experience because the quicker you understand that you're having system failure, the quicker you can change it and start doing things correctly.
Perfect. Yeah. Say, what has changed in the markets since the turtle era? Like it's 40 years now, right? And say what in your view has not changed at all in these 40 years?
Well, like I said, I think trading longer term is mandatory. Um, I don't think people are any smarter, and I think trend following works great. There's so much computer power that people can get away from a strict trend following approach to add things to their system that they shouldn't be adding. Um, I think a good thing that's been changed over time is more markets. I think all these markets work great with trend following, the ones I mentioned, stocks, ETFs. The more we have more commodities, more currencies, and more interest rate markets than ever. Lots of stocks, of course. Bitcoin and crypto is, I think, the next big phase. We have crypto futures with Ethereum, Solana, Bitcoin. We have ETFs that are going to be as good or better than trading the futures. These are great. So it's just been a wonderful to started with 25 markets in 1983, and now we're trading hundreds of markets. One of our funds trades 400 markets. And half of those are stocks, of course. So that's just a great situation where we can trade the trend following and trade um, moderate size, moderate leverage, and the diversification helps us find more trends and have a smoother performance in a good way. Adding diversification is the way to make your performance smoother and better, making the more markets you have, the smaller you can trade, the smaller the bet size is, and the smaller the losses are. And it's the only legitimate way to smooth out the daily performance and the weekly and monthly performance. It didn't help much last month, but most of the time, trading hundreds of markets really does help because anytime you add something to your system, a new entry, a new filter, a new parameter, a new way of getting out of trades that's not trend following, this just weakens the systems and makes them less robust. I would say the skepticism around trend following hasn't changed at all either. I think people don't like it. They don't think it works. They need something that has profits more often, even though it does well overall. Um, and so I think that the desire to trade trend has lessened, I think, to some degree. People will trade trend, but not classic pure trend following the way that I describe it.
You just said that some people trade 400 markets. So, and there's one set of people who, like Warren Buffett, who said that concentrate your trades, right? And another set of people who said had diversification. So, what do you think is like better? Nothing is wrong, I know that, but which is better among these two?
Trading hundreds of markets or trading um,
Concentrated markets.
concentrated? Yeah, that's a good question. I think for a technical trend follower, trading hundreds of markets is better because one of the principal philosophies of trading trend following is we're going to trade all the markets with the same systems and parameters. And in this way, if we treat all the markets the same, we're going to treat the longs and the shorts the same. So in this way, when we do our back test, we can come up with thousands of sample size, thousands of trades to make a sample size as large as possible. So all of these trades are created equal. They all have the same expected return. Now, if you're trading discretionary and value like Warren Buffett, you're not using that framework. All your trades are not created equal. Every trade with a trend follower, when it hits that breakout entry, it has the same expectation. With Warren Buffett in his own mind, when he's doing value analysis, he has a number one trade and he has a number 10 trade. And number one is better than number two. Number two is better than number three. So in his way of doing things, his strategy, um, if he had 100 markets, why would he want to trade his 100th best idea? All of my trades are the same. They have the same mathematical expectancy to make money, the same expectation per trade. So it's much different when you're looking at systematic trend following, back testing, and versus more, I would say, more subjective approach of determining what is value and, in your opinion, what is your number one and number two and number three and number four and number five idea. All of our ideas are the same. So whenever we so
Say,
whenever we add markets, we don't diminish our expectation. All we do is reduce the volatility.
okay. And say, what do you recommend? How much? Say, do we keep a number of fixed open positions in a system or in a setup?
Do we keep what's
Um,
that again?
maximum limit of instruments, open instruments in the system.
No, no, no. We have a max. We have a number of positions in our portfolio, and we're applying our trend following system to each one of these individual markets. So we could get into a period where um, everything is trending higher. So we have a position in every market, and they're all long, or we could have a position in every market and they're all short, or we could have almost no positions on because nothing is trending. So the trend following is only taking positions when the system entry gets elected, and it's holding on to those positions until they get out. So there's no predetermined max number of positions open or minimum open or anything like that. We're simply following the system and are doing all the trades that the system generates.
So, but if we don't keep a max number of open positions, then how will we have the capital? Because say if say we have limited capital, right, and new trades keep coming in, right? If the trend is becoming stronger and stronger, then how will we get the capital for the next trade?
Before we start trading, we do our research and we understand how much capital I'm going to need if I have a position in every market. And then that's how we determine the size we're going to trade. We cannot have a system that limits the positions we can take. That's violating the rule we talked about an hour ago, which is we must take all the trades when the system says to take it. I can't take this trade. I don't have room for this trade. I don't have any capital left. Well, you've been trading all the other trades too large. You need to set up your trading system so you can take all the trades. Now, it's going to be unlikely that you're going to have all the markets trending at the same time. So maybe most of the time it'll be 1/2 to 2/3 of the markets that you'll have a position in. But you need to take into consideration that you want to do all those trades and you must do these trades. You must follow these systems. And if you decide not to do a trade because you're undisciplined and you refuse to put the trade on, you're afraid of losing money, and it makes a lot of money, and you miss a big outlier trade, that's absolutely no different than saying, I can't take this trade because I don't have any room in my portfolio. Well, that could be the big one that makes all this money and you didn't take it. So it doesn't matter the reason. The math gods don't care. You need to take those trades and set up your system so you can afford to take all those trades. Trade each of your other positions smaller so you can afford to take the trades as they come up.
But then, if we do that, then like our position size in each trade will be very small. If we say are tracking say 100 securities, then and if the signal comes in all 100, then we'll have to take each trade say one by 100, right? Obviously, we are not adjusting for risk in this case or volatility in this case. But then our size will be too small to be any major effect on our portfolio, right?
Yes, and that's what I do. That's all true, except um, our overall risk remains the same. So it's good to have these small positions that um, don't have a huge impact on our trading, because when we lose money, the loss that they generate, it also doesn't have a big impact on our trading, because
Correct.
But overall, my risk budget is the same. So if my risk budget is trading with 20 markets or 200 markets, my risk budget is still the same. I'm going to get maybe 10% of my trades are going to be outlier trades. 10% per year are going to have really large moves. So if you're trading 20, that's going to be 2 trades. If you're trading 200, that's going to be 20. So it really is a situation where trading lots of markets with trend following is the greatest thing going. Now we trade 400. So we can afford to take all 400, and each trade is really small. So that reduces our psychological stress and our anxiety level because each trade is insignificant. But when we add up all of the trades, the expected 40 outliers per year that we're going to get, this roughly 10% of the trades might be outliers, then we add them all up, they're going to have the same performance as if we traded a lot fewer markets.
Great, Jerry. Now I think I'll open the stage for the audience to ask questions. Okay, so anybody who wants to ask question can raise their hand, and one by one we will allow you to unmute yourself and ask question directly to with Jerry. Okay, so first question has come. Amit has asked a question. So Amit, you can unmute yourself and you can ask your question.
Hi, it's wonderful to have you here and learn from you. Really wonderful. We had seen your books, but then it's really good to see you live here. And thank you, Soviet and Trading Heads, for organizing this. My two simple questions were, one, what is your exit strategy? I mean, to be specific, like what is, if any number was supposed to be assigned to it? And we talked about optimal loss. So how do you define this optimal loss? Like, is it like what number do you have in mind, and what strategy do you apply to have optimal loss?
Well, I think with the optimal exits, like I said, the exits need to be based upon a back test and allow you to stay into these trends that last for a year or two. Something like 50-day moving average crossover of 200 days. So 50, 200 is a really good exit strategy, entry and exit. I like both. I like that. That's fairly long term. And I think so. Something on the breakout side would be at least 100 days. So you would get out at the 100-day low at least. So maybe the 200-day low and things in between. So at least 100 days breakout. You don't want to be any shorter term than that probably. And then the stop loss is going to be in terms of the ATR. So the turtle stop loss back in the 80s was two ATRs. That's too short term, and I think 10 ATRs is too long term. So something in between there in terms of ATR. And once you do a back test, it'll show you where the optimal stop loss is. And trading multiple stop losses will be fine too. So maybe you have a couple systems that have a certain stop loss, and a couple other systems have a different stop loss, but still not too close, not too far away.
I hope you got the answer, Amit. Okay, anybody else wants to ask a question, or there are some questions in the chat box? I'll ask them. Okay. William is asking regarding gold and sustained trend. How do you backtest how many lots to pyramid up?
How do you back test?
How you
What?
backtest how many lots to pyramid up
How many lots to buy of gold?
and pyramid it?
Oh, and pyramid it. So I don't like pyramiding. I think what I do is I trade multiple systems which have different entries. So if I want to risk, I'll determine how much I want to risk in gold, and I'll divide that up between the systems. So if gold keeps going up, I'm buying system 1, system 2, system 3, system 4. I'm not really pyramiding. I take pyramiding as something that you don't really want to do. Um, if I'm going to risk 1% of my equity in gold, um, that's my rule, and I'm going to do that. And so sometimes only system 1 and system 2 will enter, and system 3 and 4 won't enter. So I won't risk the whole 1%. With pyramiding, I think it's not a good thing because people say, okay, I'll risk 1% in gold, but if gold keeps going up, I have this open profit, maybe I can risk more. So I don't believe in risking more based upon the open profit, because the open profit can go away very quickly. So determine what you want to risk, how much of your capital you want to risk on every trade, divide that up between the number of systems that you have, and that's the way I do it. That's the total way of doing it.
Correct. Thanks, Eddie. Suresh is asking, Indian market is in good condition, trading above 24,000, but there is war-like situation in India. How trend following systems work in such situations?
Oh, can you repeat that?
Yeah, actually, he's saying that Indian markets are in good condition.
What
They
market?
are trading above Indian markets, the
Indian
Nifty.
markets. Okay. Okay.
I'm
Right.
not sure whether you track it. Okay. It is about 24,000 as of now. But as of now, there's a war-like situation between India and Pakistan. So, what do you think that in such situation, what uh, should be done?
Oh, wow. Yeah. Um, I think that for me, I would just ignore what's going on, ignore the fundamentals. Yeah, I'm looking at that chart now. Yeah, I mean, I'm just going to follow my system. It's one of lots of markets. It's one of hopefully hundreds of markets or 50 markets. So the position size is not too large, not dominating. I prefer to trade the individual markets. I don't like trading the index. So it gives you more diversification if you trade some of the stocks that are in the Nifty. But yeah, I would just I'd have to follow my rules, follow my system. And once again, if I'm losing too much money and my portfolio is in general is losing money too rapidly and too fast, I may decide to trade smaller, just reduce my positions pro rata across the board. But no, I think so far, I think if things got worse and it looked like things were getting worse and the markets were really unstable and volatile, I think it's fine to reduce your positions dramatically across the board and to preserve for capital. But I don't have anything to add as relates to when can we override our trend following. I think the way to override your trend following is to reduce your positions so you can keep following the system at a reduced risk level.
Okay. One question from my side, additional question, just it came into my mind. Do you see breadth indicators like how is the breadth of the market?
No, I don't pay attention to it. I only pay attention to the breakouts in the stocks. I think it's very much better and mathematically more legitimate to apply the system individually to each market and don't look for confirmation. Your confirmation is per market. If you're long, you've got all the confirmation you need. We always want more and more. It's just, once again, it's this desire. What can I do to not put on a bad trade? Nothing. Put the trade on. You have all you need at your disposal, and that is the small loss. You're going to risk a small part of your capital. So be bold, because you're really not being that bold, because you're just going to risk a small amount of your capital. And so many times, though, I think that sort of stuff doesn't work because the overall sector, whether it's stocks or metals or energy or grains or anything, it doesn't look very strong, and not everything looks strong. Then out of the clear blue will come gold. No platinum, no palladium, not really much silver. Gold is the superstar. But we didn't see much support. We didn't see the sector. We didn't see breadth. Yeah, forget that. You're hunting for the outlier. You're hunting for something that is unusual. And I was in a couple of trades, like I said, in Feb 1984, the February heating oil was so strong. January wasn't strong. March wasn't strong. Crude wasn't strong. I've seen it happen in heating oil a few times, where 1 month of heating oil had a big outlier trade and crude sat there. In 1987, silver doubled or tripled in price. Gold didn't do anything. So CTA trend following is the best when you see things happen that you've never seen before, and people want to have excuses for missing a trend. But we'll never miss a trend. We have no excuse. All we have is the breakout or the moving average crossover, and we're in it. And we don't need anything else to convince us. We've got all we need.
Perfect, Gary. There's a question from Mustafa. Which elements of strategy have proven to consistently perform well across varying market conditions?
Oh, can you repeat that?
Yeah. Which elements of the strategy have proven to consistently perform well across varying market conditions?
Well, I think the strategy is a component of all the different parts. So I don't think you can take one part. It's all, you've got to do everything that we've talked about: the entry, the exit, the portfolio, the money management, the sizing. It all is one, it's all one, it's all the same. So it all works pretty well over time. I think that's the problem with trend following, is sometimes it takes a long time for it to start working, and you can go a long time where it doesn't work. But the times that it hasn't worked, people have run studies and determined that it's really just a lack of trends, a lack of big trends, which we have no control over. So to some degree, that's frustrating, but to another degree, we're not to be blamed for it. Now, we could be blamed for choosing trend following. I'm not going to trade trend following because you trend followers are sitting around waiting for these long-term trends. 1 year, 2 year trends, they don't happen that often. I'm not going to trade trend following. I think that's fine. Good luck. Find something different and better. But it's really to some degree, we're correct in judging ourselves by our ability to follow the system and maybe make incremental small improvements over the years. Although, if you bought cocoa and coffee or shorted the bonds in 2022, and you saw the power of these big trends, then you sort of see that it's very difficult for a human to come up with something to improve the system that's going to have as material of an impact as these big trends. And likewise, missing those big trends, it would be almost impossible to find something to improve your system that's going to make up for simply just missing, not buying that breakout in those markets that had huge trends. So there is nothing we can do. That's the power of the market, is don't get in the way of the trend following. Don't mess it up. Don't get out of your good trades too quickly. Follow those rules.
Perfect. Yeah. There's a question from Kalpa. She says, what is the best strategy for bearish or range-bound market for day trading? I don't
Oh, I
think.
don't know anything. I don't know anything about day trading. I hear that
Yeah,
some people trade trend following on 5 minute bars or 1 minute bars. So I'm not sure if that works, but not a day trader. I never have been interested in trading short term like that. I know a lot of people think you can combine long term trend following with short term. Not something I've ever done before.
perfect. Okay. Venkateshwaram is asking, most new traders are limited to only trading in stocks in a single market. Would we still apply the same rules for a single market system?
That would be tough. I mean, I would, but I think it's very important to trade 10 stocks or 20 stocks, trade them really small. So I don't think that's a problem in the US with, I guess it depends upon how much money you have and how much your capital is. But yeah, I mean, I think you can get lucky. I've heard of people get lucky, and then over time they knew that the most important thing to do as they made money was to expand their portfolio and diversification. So maybe that's how you have to do it. But for me, yeah, I would just do trend following. But I think that would be very difficult.
Anurag is asking, one of the important concept of trading is follow your trading rules. But as we are a student of market and learning from concepts, learning new concepts, so if I get a new concept, so should I add that concept which may chance my original strategy?
Oh, I like that
Change.
question.
Yeah.
Yeah, that's a good one. Well, I think what I've done is, well, I think you got two things going on here. So if you're trading a trend following strategy and you want to add a new concept to the trend following strategy, it's still trend following, let's say, then put it in the back test, put it in the computer and see how it works. But if you have a totally new concept, then you would test this concept on its own and then add it to your trend following strategy as a separate, you know, not combine the two, but see how the two work together. So and that's what a lot of CTAs over the years have tried to do. They would take the trend following and add maybe a mean reversion, a pattern recognition, a carry trade strategy, or different types of strategies that diversified the portfolio. One half the portfolio would be trend following, and the other half would be something else like this. And so it really just depends upon the back test. And does the back test tell you that it warrants to be part of your overall trading? Once again, you don't want to get into a situation where you have a new concept on trend following, which is I'm going to get out of a great trend like gold when the volatility increases. That's what people do. Most people do that. They use the concept of sizing the position with the ATR at the entry price, and they extend it to, well, I'm going to reduce this position as the trend in gold gets bigger and bigger because gold is getting more and more volatile. Gold is too much of my portfolio. And the turtle rule was normalize the losses. Well, gold is not a loss. If it had to turn into a loss, you were going to risk X amount of ATRs and limit the loss to the same percentage of your capital as you would all other trades. But now that gold has become a big trend, we can ignore this definition of risk. But that's not what most CTAs do. They carry that risk definition forward in saying, we don't want to have this large position in gold and be subject to this big outlier trade because it's too volatile, it's too crazy, it hurts our Sharpe. That's what you need to avoid.
Perfect. Yeah, Chetan is asking, with so many scam projects in crypto, where a top 50 high market cap project can crash 80 to 90% in 1 hour, how do you diversify your trades in such case? There are more than 22,000 crypto projects right now. How do you select which cryptos to trade?
Very good question. I agree with all of that. You need to be very careful on selecting your crypto markets. And so we don't trade very many because we require them to be a futures market or a well-respected ETF. So we traded Ethereum and Bitcoin futures for when they first came out. So you're not subject to the scams. It's a futures contract. And then we switched to well-respected ETFs from BlackRock. And I think Solana is out now as a future. And we will start trading Solana as well as a future or in a well-respected ETF. Other than that, I would not do that. So you're not going to be able to take advantage of all the diversification that one could get in crypto. I'm afraid of that as well.
Perfect. Yeah. Suresh is asking, what percentage of total capital would you suggest to put in one trade?
Um, small as possible. I would say it depends on the number of markets you're trading, of course. So your first question is, what's my total risk going to be? If every trade went against me, how much would I want to lose? And so then just divide that by the number of markets. But yeah, it's really a tough question because it really just depends upon the number of markets. I have the same risk budget for a fund that has 120 markets as the fund that trades 400 markets. The same overall risk budget of how much I'm willing to lose in total. I just divide it one by 120 and I divide the other by 400. But you know, 0.1%, 0.25%, max. Yeah, small.
Perfect. Okay. William is asking, what is your impression of event sampling instead of time sampling for underlying data? Time bars versus range bars or other non-time bars?
Yeah, I only use the closing prices. So that's all I use is closing prices. It really helps with cleaning up the data and having reliable data to only use the close. And so if I'm using a breakout, it has to be a close above the highest close, a close below the lowest close. And of course, moving averages use only closes as well. So I'm not well versed on anything beyond these really simple concepts.
Perfect. Okay. Vivek is asking, you said you expect achieving 20 to 60% return from your systems combined as you have a bucket of markets to trade into. What your thoughts about maximum drawdowns in those systems?
Yeah, well, I can't really say what the maximum drawdown would be, but I think as people said many times, your maximum drawdown is in the future, unfortunately, possibly. You should always be afraid of your max drawdown being much larger in the future. But I do think that a good rule of thumb might be that your max drawdown is going to at least be twice your average return. So if you're trying to make 15%, if the computer in your back test shows 15%, you're probably going to see a 30% drawdown, at least, and maybe larger in the future. We have to be
That's the
careful
eye-opening,
giving
yeah.
people, yeah, no, yeah, it's very
And
eye-opening. So, yeah,
and a horrible truth, right?
yeah, horrible truth, yes.
Okay, Vivek has another question. What is the benchmark for drawdown beyond which you do not deploy these trading systems when it comes to trend following trading strategies?
You know, I think that's just a personal decision, and I'm not sure what that would be. Like I said, you need to understand where your cutoff is and make sure you don't get there. And the way to not get there is to keep reducing your trading size so you don't get to that level. I have heard traders say, someone told me the other day that they have a friend who's famous and he was a trend follower. And he said, if I lose half my money, I'm going to stop trading. And I think that whole idea that is going to tell you something is wrong. I don't think it tells you anything. It could be exactly true, but with this guy, he said, I quit trading, and then that was the bottom, and the markets were amazingly great for the next 2 years. Yeah, there's no sign or light switch. There's no number that's going to tell you that. Things could get a lot worse, and he could have been 100% right, or things could get a lot better. We don't really know, and there's no one who can tell you that. That's predicting the future. We're not in the business of predicting. We're following trends and following math and the expectation of the trades that we see that we got in our back test. It's all about the back test. That's where your
Right.
confidence should come from and the number of trades you're looking at. Hundreds or thousands. You need to see thousands of trades. Entry, exit, stop loss. Entry, exit, stop loss. You look at those trades and you average them all together. You average the currencies, the commodities, the stocks, and the bonds together. You don't look at them separately. you average the longs and shorts together, you don't look at them separately, then you have your max sample size, then you can make an inference about what is reasonable for the future. Reasonable for the future, not what's going to work in the future, because we don't really know. We're guessing, we're looking at probabilities.
That's
This
great.
type of strategy is available to everyone, and that's why it's so appealing. So many people you read about do things so much better with little drawdowns and more consistency. But here you're offering something to people that they can actually implement, and they can see why it works. I remember when I first heard about trend following, I was 25 years old, and I read a book or I read a magazine article, and I said, oh, okay, you take these small losses and you let the profits run, and you're going to get some big trades. So the question is, are the big trends going to pay for the small losses? And I hadn't even heard of Richard Dennis yet. And so, yeah, maybe it will, maybe it won't. But I could see how this could really work. Longs and shorts, I don't know anything about it, but sure, more diversification. Currencies, commodities, and interest rates, yeah, why not? It sounds a bit safer than just stocks only. So that's what I had initially. I thought it was wonderful and great. And then I met Richard Dennis, and then I had all this experience. So now I think it's even better than that. But I think that's where you need to get. You need to fall in love with trend following and your systematic approach, and learn how to follow it more consistently.
Perfect, Jenny. I think we have run out of time. Okay. So we'll try to wind up here. Okay. Any questions further, or we'll wind up here? Okay. I think there are no further questions. So thank you, Jerry, for not just sharing insights, but for pouring decades of experience into this session, from turtles to titans. Your journey continues to inspire rule-based traders across generations. On behalf of everyone here, it's been a true honor. We hope to have you back again soon. Until then, trend well and trade strong.
Thank you so much for having me. It's been fun. You had great questions, and I look forward to seeing you guys again.
Yeah, and for the participants, we will post this video on our YouTube channel. You will get an email with that link. Okay, so stay tuned. We'll again have some new guests in the next webinar. Okay, the next uh, guest will be Mr. Rakesh Pujara. Okay. So we'll be putting the details soon on our LinkedIn and Twitter handles. So keep following us. And thank you, Jerry, again for the wonderful session. I think there were some insights which even I didn't knew, and some breakthroughs which I also had to think about again from here on. Thanks a lot, Jerry. I cannot thank you much in words.
My pleasure. My pleasure. Let me know if you're in the United States. Well,
Yeah,
I can meet you
definitely.
if you come to New York City. I'm up in New York frequently, so just let me know.
Yeah, definitely, Jerry. We'll
Okay.
try to meet sometime. Sure.